Hey guys, so I just wanted to quickly talk to you about a Section 179 deduction, which is basically a deduction that is allowed for business owners for assets placed into service, which allows for pretty much full deduction with limitations on those assets. What does that mean? Basically, a common example would be if you buy for or finance a vehicle at the end of the year, you can write off the entire vehicle if it meets all the criteria. So the important thing there is to understand that you haven't paid for the vehicle yet, but you're already writing off either partial or all of it. And that might be really good for your business because it might greatly reduce your taxes, because you're basically writing off an entire cost of the car. Now, like I said, there's limitations, many limitations, so you would definitely have to check up on that first. Doesn't apply to like leased vehicles unless it's certain types of leased vehicles. Yeah, I'm walking my dog. That was the neighbor's dog. But other than that, unless it's like a capital lease or something like that, which is very specific. So again, you would have to check before you're actually going ahead with anything. So why is this good? Well, at the end of the year, you can actually get into a car for your business and write it off without having paid $1 into it yet. Now, the bigger takeaway is that this might not always be a good thing for you, because you're reducing your taxes now, but you'll obviously have more taxes than later, and that's what a lot of people lose sight of. So it becomes like, well, what if, let's say, next year's tax rates are higher than this year? Your deductions would have been greater had you waited till the next year. So you have to take that into consideration. You would also have to take into consideration that you can spread out the deduction over 5 years, which is a more conservative approach, giving yourself more even deductions for the next 5 years. Once you deduct the car in full for your business, that car has like basically zero value in your hands as a taxpayer, and that's zero taxable value, what we call zero basis. And then so if you sell it tomorrow or trade it in, you're going to trigger a gain because you're getting some value for it, and now for tax purposes, that value you're receiving becomes income to you, or taxable income. So that's kind of like, again, the premise is more taxes later versus less taxes now. So that's where a CPA with tax planning strategies can basically implement for you. What I've seen in practice is elections being made for clients without them knowing it, and that's pretty not good. So if you're getting any kind of assets, you should have a discussion with your accountant as to what kind of depreciation or deduction you're getting for this vehicle for your tax situation, or any other asset. Like I said, it all depends on what you're aiming to do, and the outcast for the future and so on. Hey, how's it going, buddy? Yeah, so we got kids playing hockey. I used to play hockey. Stay tuned for more.